Ladies and gentlemen, welcome to this DMH Stallard webinar brought to you in association with NatWest Bank. Today we're covering your business navigating for recovery and reset. If you have any questions, and this is the administrative bit for the panelists, please put them in the Q&A section of this webinar. If you have any technical questions, such as you can't hear the panelists, please put them in chat. So without further ado, because time is pressing, I'm going to turn now to Victoria Kerton. Victoria is NatWest's Regional Director for the key market of London, Surrey and Sussex. She leads a large team of experienced commercial banking relationship managers and directors. She has over 20 years market experience supporting UK management teams as they look to grow their businesses, raise capital, and acquisition finance, restructuring and executing debt mandates across the full institutional, corporate and commercial franchise. She specialises in the mid-market, commercial segments and family businesses. And so without further ado, Victoria, over to you.
Thank you, Johnny, and it is a pleasure to be here. Good morning, everyone. So delighted to join DMH Stallard to share insights and themes emerging from the most extraordinary year of economic, business and funding activity I've ever known. I have written my speaker notes because I want to be tight to the time, so please excuse me if I look to my notes. Before I move into my updates though, I wanted to share just a little bit about me in terms of, I'm an economics graduate. I'm from Sydney with the Masters in Applied Finance and Investment. Been working in London for some time and always expected my professional career as being underpinned by my finance degree. But now I'm returning to my university textbooks and I'm refreshing my knowledge of macro and microeconomic behaviours and activities, because never did I envisage an economy with the return of big government, huge fiscal interventions, labour market support and weakened monetary policy. 12 months ago, this was unthinkable. But against this context, my current role, as Johnny outlined, I lead a team of about 90 relationship managers supporting the SME and mid-market across the Southeast. My region has a client base of over 2,500 businesses, and I'm really pleased to report that today the majority are surviving this crisis, and many are readying for recovery themselves. And I will share insights and learnings to consider for your own business planning. So let me give you some context. Amber, if we could move to the first slide, please. Thank you. The macro environment. Benchmark consensus forecasts a 9.9% GDP contraction for 2020 year on year. This follows the initial fall of 22% experienced during the first 2 quarters of this year through our national lockdown. We are seeing and feeling a sharp V-shaped recovery, and the latest consensus still looks to this V-shaped recovery, but with some scarring of 2%. And also modestly higher structural unemployment. True to this V-shape, we have seen UK GDP recover through July and August, but this is likely to lose momentum, with the widely watched Purchasing Manufacturing Index surveys appearing to confirm that even before the government tightened restrictions of the last few weeks, that the pace of growth was decelerating across both manufacturing and services sectors. September's flash composite reading dropped to 55.7. So we're still expecting growth, given this is a measure above 50, but it's below consensus and down from 59.1 in August. There continues to be intersectoral variations in the pace of this rebound, and capex intentions still look weak. If we could move to the next slide, please, Amber. So with this, some more contrary indicators. Immediate uncertainty seems to be receding, and revenue estimates are continuing to improve month on month. And this is something we see across our portfolio of customers too. But the labour market fallout is still in its infancy, and weakness in demand is likely to take over. And this is reflected in falling inflation expectations and interest rates for the next few years. Markets have now baked in negative interest rates with very gradual lifting expected through to 2024. So moving on to the next slide, please. At the onset of this crisis, the Chancellor announced multiple interventions to support UK PLC, established the business interruption loan schemes for SMEs and for corporates, and also the bounce back loan scheme. The sheer scale of this borrowing, as I have outlined here, shows the critical relevance of this funding to the UK economy. And these are staggering volumes. NatWest has funded approximately 22% of the market share. As a bank, we've already agreed £12.5 billion across the main schemes, and with the commitments supporting the London and South East region, representing a material proportion of this 12.5 billion from NatWest alone. So this is of course alongside a wide array of economic support programs with the aim of protecting employment through liquidity. And these measures have been material, and many businesses will benefit, but not all. It has also changed the financial and economic landscape with long-lasting effect. So 6 months in, what have we learned from this? What are the emerging themes or accelerated trends or structural shifts which businesses need to consider for planning for their road to recovery or their reset? So I've captured here in 5 bullet points 15 huge themes. They are big themes. They're relevant for larger and for smaller businesses. And these are the things that we're speaking to our customers about. Our customers are in different phases and stages of planning and response and activity. But the thing which sets the stronger businesses apart is the awareness of these themes and how it relates to their business sustainability. So I'll speak about these briefly each in turn. Position in market. What do I mean by this? Really, what I mean is knowing what your demand drivers are. What are the demand drivers for your product or for your service? And quite often we think we do, but do we understand what they are now and what they are influenced by? What is the competitive landscape? How has it altered because of COVID or accelerated megatrends? Do you measure? Do you target? Do you even care about customer experience? And what is your brand? And how relevant is your brand value? So what has been evident through COVID is the flight to brand seen across many sectors. So this brand value could be quality, it could be longevity of brand, or it could be the customer experience. So do you know what yours is? End markets and supply chains. These are not often interlinked, but we are seeing businesses with deeper integrations into their end user or their end markets demonstrate better viability than commoditized sellers. How do businesses integrate? Well, strategic supply chains, strategic partnerships, aligned purpose, could be transition to a net carbon zero purpose or stated aim, could be sustainability or wider ESG purpose. And these are accelerating themes, and these are building these strategic supply chains and partnerships. On top of this is the relevance of digital journeys and distribution. So these give access to different buying behaviours and many businesses the resilience that they need. Structural shifts to the marketplace and the economy. Well, structural shifts, there are many economic terms and meanings, and I'm referring here to the impact of dislocation and disruption, which accelerated digital technologies have effectively delivered. We've seen high impact sectors through COVID, like travel and leisure, with participants collapse into administration, but we've also seen others soar in valuation, but this is because of their underlying digital technology. We have seen consumers driving the specifications of corporate technology. And if you aren't aware of your consumer or customer need, then you need to be. Marketing, buying, decisioning, distribution, AI, cloud, connectivity. These are all accelerating digital technologies which will drive permanent shifts and present businesses who are strategically aware opportunities to grow beyond pre-COVID levels. And these structural shifts are already evident. Simple things too. Who would ever have thought the London Marathon would be run virtually for the non-elite athletes? But this year it will be. And not only that, its capacity sold out in only a matter of days. Next year is already in advanced planning. Available debt capacity, liquidity, cash flow, capital. Through this crisis, we have had a lot of discussions with customers about these aspects of their business. How do you measure debt capacity? How to access it, and how to balance the immediate liquidity needs and availability for recovery capital or for your working capital as trading resumes. There are some interesting things which I thought I would share. Changes to working capital profiles have been profoundly evident through 2020. Some will be temporary, but some will become more permanent. And we've seen significantly altered terms of trade across our broad customer base. We've seen changes to supplier terms, immediate payment in many cases, extensions to debtor days, but utilising a longevity or the importance of a relationship to drive these. Terms of trade have altered, and these will continue evolving as relationships reset, but also through the use of different funding mechanisms. What insights can I share? It's imperative you know your working capital cycle and your working capital needs. Look for ways to fund your requirement and look beyond the traditional. Explore settlement terms for digital merchant solutions. They vary across providers. They could give you the invaluable extra day or 2 days in terms of cash flow. Explore your trade instruments to unlock cash or enhance your terms of trade. Use new digital or explore new digital discounting and invoice solutions. Review your management information accounting package. Can this unlock other new fintech solutions which could give you access to alternative ways of supporting your working capital? And these could complement your longer term capital needs too. Banks, alternative providers, fintechs, we are all evolving rapidly and we offer different solutions. So make sure you maintain relationships and don't always settle for the easiest option. As for capital, since August, we've been seeing activity return to mergers and acquisitions. A combination of vendor fatigue or withdrawal from markets, increasing sell-side mandates, together with considerable dry powder from private equity, venture capital and family offices. Trade sales are also in the pipeline, and in almost all cases, the acquisition of skills or key market access is the compelling rationale, alongside tech, of course. We will hear more later from Jonathan regarding this, but the disciplines for getting your business investor ready also equally apply to your funding discussions with your bankers and your lenders. Looking forward, banks have written huge amounts of assets to their balance sheet and will require, in many cases, intensive risk management. But new lending appetite still remains. The UK high street banks are well capitalised today, and there is strength in the liquidity ratios too. NatWest's Tier 1 capital ratio is over 17%. This is almost double back from the days of the financial crisis. Debt appetite, though, will be more selective, and key to this will be how well you represent your business planning. Use your data to support this as well. Debt capacity will be increasingly determined by earnings and free cash flow forecasts. As a matter of note, my business will only lend if we can evidence the business's ability to repay debt without undue pressure on their earnings and cash flow profiles. So we've seen customers access equity and debt capital through this crisis, and we do not anticipate a credit crunch occurring, but businesses will need to demonstrate their viability. So on to business planning and data. I cannot overstate the importance of management, and for your management and your shareholders to understand the strategic needs and costs for you to run your business and to plan for this. This means data. This means management information. This means business plans and forecasts. It means demonstrating an understanding of your revenue generators, your earnings profile, your CapEx strategy, and your available cost levers. Use your own data, but look for data too. Fast indicators, big data, regional activity, sector benchmarking. Use it. It makes a difference. Also, key to sustainable business planning is management at the operating level, commercial and strategic levels. Management capability and bandwidth. They are one of the most critical elements to business viability and a key rationale for any investor or funder to your business. Capability is easy. You can buy it in through technical expertise should you need to, but keep an eye on bandwidth. Management bandwidth, especially through the COVID crisis, has been stretched, and even the most capable are not always able to deal with everything. So lastly, the relevance of relationships, ecosystems, megatrends and connectivity. These are big themes, but ones which should already be part of a viable business planning process. The importance of relationship is easily illustrated through our webinar today. The value shared and learnt from relationship partners is often the magic ingredient to success. But think of relationships across your employees and your partners. Thinking about well-being. It's not just a nice to do in business anymore. It's a need to do. And it's a need to do for long-term viability. Well-being has been one of the most deeply discussed aspects to our customer relationships through this year. And it will be integral to ongoing business success and sustainability. As will the movement for diversity and inclusion. It is an imperative now for businesses to bring diversity and inclusion to the front of their agenda for long-term sustainability. It drives creative thought. It drives access to different talent pools. It creates different perspectives. It informs different buying decisions. Relationships are key, and it's not just in the traditional business relationship either. So building on this theme, ecosystems. Ecosystems are evolving business communities which often operate beyond sector boundaries, and we probably already all participate in one form of ecosystem or another, but being aware of it is the competitive strength. Ecosystems increasingly interconnect businesses and transform how customers serve customers and innovate supply chains. They can emerge organically or deliberately, and the relevance of ecosystems in my discussion today is the growing aspect of SME and mid-market companies and businesses now interconnecting with the globals, the OEMs, the large caps, and interconnecting them and having a relevance with real value. Ecosystems are the competitive edge. And finally, megatrends. These are the driving forces that economists use to define the world of today to predict what will happen tomorrow. Existing megatrends include digitalisation, population growth, and urbanisation. Understanding how they will affect your business is essential to informing your strategy. And history has shown us that epidemics can accelerate megatrends and can change and influence the way we structure society. The cholera outbreak was the reason for the marvel of the London sewer system. So the COVID crisis is no different. It's shaping our megatrends and it's interconnecting them to 4 mega themes, which have the potential to reshape society and our business communities. The resetting of relationships, the repurposing of place, reassessing of value and values, and the building of resilience. These themes will influence how we work where we work, how we value the different sectors and providers into our economy, how we cost them, how we pay for them. It will affect us on all levels, and how your business responds and adapts will also be necessary. So I hope these shared insights today have been helpful for you to consider how you sustain your business and navigate your own road to recovery. There are many common themes across all sectors and relevant for businesses of all sizes. But how you adapt will be key to your investment and your funding readiness for this period and your long-term sustainability. Thank you. And back to you, Johnny.
Victoria, that was absolutely fascinating. I think what comes across very strongly is that the banks, with their current capitalisation, have never been better placed to assist businesses, provided that those businesses know what they're about and can demonstrate the management tools in place, so that you're happy as a lender to come across and meet businesses halfway, as it were. I'm going to come back to you in a moment, Victoria. We've had a lot of questions, and I'm going to try and get through as many as we possibly can, but I'm going to turn now to Jonathan Grant, who is our head at DMH of the corporate department across Sussex, Surrey and London. Jonathan maintains an active corporate practice across the South East. He's experienced in running mergers and acquisitions, transactions, I should say, including management buyouts, management buy-ins and sales, and advises ambitious and entrepreneurial businesses in and throughout the South East and London, and has acted on some of the biggest sales transactions in recent years. So without further ado, Jonathan, I'm going to hand over to you now.
Thank you, Johnny. Yeah, just a little bit more background, just to give you a bit of context. So I operate in the Southeast regional business. We have 5 M&A partners across Surrey and Sussex. So we get a good spread of investment and M&A deals. So I'll try and share some of that with you today. There are some general themes, and I will also try and draw out some examples of some of the transactions we've been involved in, which will hopefully bring some of this to life a bit. Interestingly, at the moment, the London business is a little slower than the region. The region is proving surprisingly resilient. We've got a very strong entrepreneurial community in the Southeast, and that seems to be surviving remarkably well in very challenging situations. So Amber, can you pop up the first slide, please? Thank you. I thought I'd begin with just a bit of context setting. It's been an interesting year or so in the M&A and investment market. 2019, the first half of 2019 was a relatively slow market. There was a lack of confidence as fears of Brexit started to loom. There was then a sort of a further slowdown as the election came nearer, and there was a level of uncertainty. But through that year, there were some good deals done. I'll give you a couple of examples. We sold a pharmaceutical distributor to an Irish listed pharmaceutical business. They were essentially buying volume and distribution. They wanted access to the UK market as a hedge against Brexit. That deal took probably about 8 months to complete. It was slowed by the lack of competitive pressure in the market, but the deal completed very successfully after a float in Ireland to raise the money. We also saw quite a lot of builders merchants, so very basic goods businesses, UK-based businesses that had reliable demand. We sold Chandler's Building Supplies, and we've seen a number of building supply and building related products transactions which went through toward the end of 2019. After the election, the market changed dramatically. So there was a sudden boost in confidence. We got through the immediate Brexit anxiety, and the pace of transactions really started moving. Those transactions were already in play, started moving very quickly. That pressure mounted as the threats to entrepreneurs' relief increased as we got closer to a March budget. So we had, I was doing one deal at that time, which fortunately, as it turned out, closed before we got into lockdown, because it was a business supplying food to airlines, being bought by a Singaporean business. That transaction speeded up dramatically at the beginning of the new year, and we closed it right at the end of February. That business has significantly collapsed post-lockdown. So that was a transaction that got in ahead of Entrepreneurs Relief. That was the driver for it. And being able to close it quickly was critical to getting the value. So we had this fast run through to March, a lot of transactions closing as people wanted to get in ahead of the Entrepreneurs Relief reduction, which of course did happen. And then we went into a dramatically slowed period once lockdown happened. So end of March, beginning of April, activity really stalled completely. Everything went on hold as businesses started to try and work out how they would respond and how the market would operate. So if we go on to the next slide, I'll start to talk about what happened as we emerged in a minute. I wanted to just, before I do that, put up some slides which are more generic investment slides. So this is probably a standard model that investors and buyers would look to if they were targeting a business. So we start with a stable business. Growth is one of the key attractions for investors and buyers. That's both growth leading up to the transaction, so they want to see a pattern of growth, typically over 2 to 3 years, consistent, or at least a trend. And typically they will look to both revenue and profits. The measure that most investors and buyers look to is EBITDA growth, which is a slightly different variation on standard operating profit, earnings before interest, tax, depreciation, and amortization. It allows you to add back in some costs which won't carry forward and to exclude various exceptional costs. Sustainable customer base and a reliable customer base, really important. So we've had some businesses that have been challenging to sell, where they have fast growth and fast growing profits, but may be very reliant on one key customer. That produces a risk. If that customer is threatened or goes, or if there's a change of control trigger on their contract, that's a high risk in a transaction. So a broader spread customer base, which can have a few key customers, is fine. Over-reliance on one customer can be a challenge. Victoria mentioned management as key. That is fundamental, I think, to every deal we do, whether it's a sale or whether it's a management buyout or an investment by a private equity business. Existing capable management who can keep the business running through the sale period and for the immediate period afterwards is critical. And a lot of time is spent with our clients as we prepare for transactions, making sure that they have set their management teams up properly. So that might involve share options, it might involve different bonuses to incentivize management to make the business work and to provide the sort of environment that investors want to see. You can't just sell the business and walk away from it. You have to leave it capable of operating for a buyer. Ownership of key rights is the more straightforward legal stuff. So there's basic things like making sure there's no problems with the title to your property or your leases. Some of the less tangible things which often come up in our transactions are intellectual property, know-how, and some of the intangible things that make particular businesses work and give them their value. Finding a way to demonstrate that and lay a paper trail for it is often takes a little bit of time and some thought, but can have a significant effect on value. And then I've put synergy, which I think has been increasingly important over the last year. So that's the benefit of two businesses coming together, whether it's vertically or horizontally. Often it's vertically in the supply chain, so that you're taking out cost and margin and producing a greater profit overall as the two businesses are combined. And picking up another of Victoria's themes, providing a wider access to a bigger market or to different customers by using the
Jonathan, I think you've come on mute there. So what I'm going to do is, just whilst you sort that out, I'm going to very quickly move over to Simon. But I think, Jonathan, what's coming across very much is whether you're looking at financing a business, or whether you're looking at restructuring it, or whether you're looking at going to a bank and getting some form of capital finance, the crucial ability is to be able to look under the bonnet, kick the tires, and understand that management have a good control, a good idea of what's going on in their business. And that seems to be the crucial points that both you and Victoria are making. We've had a lot, I think, of issues and questions from an employee point of view. And I'm sure Simon won't mind if I turn to him now, whilst Jonathan, I think, has got some technical issues. Or have you come back to us, Jonathan? No? Okay. Quite a start to today's programme, isn't it? So turning swiftly on to Simon. Simon is a partner in DMH Stallard's employment group. He is known for his ability to deliver pragmatic and commercially practical, sound advice to organisations in both the public and the private sectors, with a particular specialism in supporting clients through complex employee relations and structural change issues. And he also advises on complex TUPE issues. And Simon, by way of introduction, what I'm going to do, if I know you won't mind, is I'm going to put to you two of the questions that have been put to us. Quite a lot of questions, as you can imagine, during this time have been directed to your area of specialty. There are two questions. They've been anonymised, obviously, for the purposes of this discussion. One is, I am a small business owner. I run a chain of retail outlets. I employ 27 people. When is the furlough scheme coming to an end? What are my options as regards my staff? I do not have a dedicated HR function. And the second question is, we are entering a period of extended uncertainty, and our people requirements may change depending upon the impact on profits as a result of the second wave, potentially, of COVID-19. What can I do now to help protect the business and support our need for flexibility from our people? So with your permission, Simon, I'm going to hand over to you.
Thanks, Johnny. Good morning, everybody. Okay, we're picking up on some of the sort of straightforward stuff first. Furlough scheme ends on the 31st of October. In terms of what can employers do now, managing that resource in a difficult time where nobody knows what the new normal is really going to involve. First thing is there'll be the ongoing government support by reference to the job support scheme. So just briefly, where somebody's working a minimum of a third of their hours, the employer will pay for the hours actually worked, and then there'll be a contribution by the government of 1/3 of the cost of the unworked hours. The employer will pay 1/3 of those. So there's some level of support for businesses. The big criticism is that where the employer actually doesn't have a need for the employee or for the job, then the support scheme is of no benefit. And the real value of the furlough scheme was it obviously delayed making some very, very tough decisions for a long period. I don't think that the new scheme really does that in the same way. Clearly, a lot of employers are looking at reducing hours, also looking at redundancy programs. I think every individual business will have to weigh up its priorities. Clearly, there is some advantage if you can get staff to agree to reduce hours, that you retain your talent pool. There is a huge amount of uncertainty. I was talking to one client yesterday. There's a sense of optimism that maybe in a couple of months' time, as a membership organisation, membership would pick up. And so therefore, a huge reluctance to terminate the employment relationship permanently. So therefore, they're looking at reducing hours. I think on a more positive note, all businesses should be looking at the lessons that have been learnt over the last 6 months. And we've seen a changing scene for all employers and employees. So we went through a phase of crisis management, then we had the furlough scheme, then we had employers realizing that there are huge benefits to employees working remotely. And it really has encouraged employers to think very, very hard about the way in which they operate. But at the same stage, we're also seeing serious concerns about the damage that home working and remote working can do in terms of isolation. I think Victoria is absolutely right that well-being has to be at the top of all employers' agendas, and it's about relationships. So what I would be saying is that all employers need to be thinking very hard about the relationship with their staff. I mean, the isolation, the damage to mental health, the difficulties of establishing a culture within an organization, the difficulties of helping people to collaborate together are all very real. So I think all businesses, where their business involves an element of remote working, need to be thinking very hard about those themes. And typical things that employers are looking at are ways of making sure that employees don't suffer from isolation, encouraging them to get out and about, encouraging them to meet colleagues where that's possible. Employers looking at the way they communicate. A huge amount of information is conveyed through tone, through body language, etc. A lot of employers are rethinking how they use communication tools, trying to abandon email to a degree, trying to promote the simple use of the phone, video contact, all those very simple things that where you realize that there's a problem, there's something that can be done. I think for a lot of employees, there's a risk that they'll feel they'll be missing out if they're working from home. So it's looking at strategies to make sure that staff don't feel that they're missing out, for promoting the relationship. So I think that focuses on making sure that you're in regular contact. The one-to-ones that maybe happen once a month, perhaps they ought to be happening once a week. Making sure that you don't ignore employees' career development. Those annual reviews that took place, they need to be freshened. They need to take place more regularly so that the employee feels connected with the employer. And I think that probably the last thing that I would say in terms of encouraging employers and what they're looking at, again, particularly where there's an element of remote working, is to establish a culture where there's accountability and ownership for the operation of remote teams. I think that managers need to step up to the plate and realize that it really does involve a different skill set where you're managing people remotely. They need to take ownership of the teams that they're managing, and they need to use the data, as Victoria is saying, to make sure that they have information to take sound decisions and to provide feedback to employees.
Thank you very much, Simon. Just remember, before I start speaking, I have to take myself off mute. Very quickly, I think, can I turn back to Jonathan and see if Jonathan, are you back online?
Yeah.
Lovely. Well, look, can I ask you to pick up where you left off?
Yeah, I was just getting to the interesting bit. So, okay, I will gladly do so. Okay, just a quick reminder then. So just set the scene with the standard pattern that investors and buyers are looking for. Strong customer base, growing revenue and profits, viable management, and some synergies to put the businesses together. And if we can perhaps move on to the next slide, Amber. So the big question, what happened as we came out of the lockdown? What happened to M&A and investment activity? Well, the good thing is it didn't stop completely. But I think it's fair to say that the lockdown and COVID has affected businesses in dramatically different ways. We've certainly seen quite a lot of businesses have actually strengthened and have been successful as a result of some of the demand drivers that have come out of the crisis, but a lot of businesses have clearly suffered and have had to recast and replan. So the types of businesses that have survived, this is the pattern we've seen. So professional services businesses and supplies to professional services businesses regarded as relatively stable. can still operate remotely. Logistics, perhaps one of the things you might not have initially thought, but moving goods around to international markets, being able to get them out and to sale, whether it's delivered rather than in shops. Fairly expected IT, software as a service and communications businesses, again, attracting interest because there's strong growth. But all of them have that pattern of stability with credible short and long-term plans. To give a bit of colour to that, right in the middle of lockdown, beginning of April, we started a transaction to sell a VAT compliance business. It's based in Brighton. They provide, and this is publicly announced now, they provide services to European businesses on VAT across Europe. So they manage the different VAT regimes. They had been thinking about planning sale for a number of years, and we've been working with them to prepare the business. We'd looked at a number of different potential deals, including private equity, which they decided not to go with. They decided to put their own business through another period of growth. And they were approached at the beginning of May by their software supplier, who approached them with a view to buying the business. So the businesses knew each other well. The key thing with this business was that they had already prepared and spent a lot of time thinking about what they would look for investment or in sale. And they had advisors, both ourselves and corporate finance advisors in place. We managed to complete that deal in 6 weeks. That's from setting up a data room, negotiating the deal and closing it. And that was only possible because everyone was prepared. It was a fairly unique deal. The clients knew each other, buyer and seller. There was a high level of trust, and the business was performing consistently through the transaction period. At the moment, we're starting to see more sector-based focus. So a lot of communications and IT businesses starting to attract investment because it's seen as a fast growth opportunity. So I've said both the sector and the investor are important. We're still seeing quite a lot of overseas interest. So overseas companies that are well resourced and have cash, investment funds ready, looking to expand their businesses and grow into new markets. We've had 2 large Singaporean companies buy clients in the southeast. PE and investor interest remains high. We're seeing both, again, Victoria mentioned family funds and private equity. We're seeing family funds that typically comes from either very wealthy families, sometimes from abroad, looking to put their investment money into safe havens. It also applies sometimes to entrepreneurs who've sold very successfully and have got cash to invest. So those can be quite benign investors. Again, the synergy links between businesses are key in this period. Stable business that keeps performing and you can take cost out of the combined business and add profit just made sense. So those were the sort of transactions that moved more quickly. If we can move on, Amber. So delivering successful deals. Still talking to quite a lot of clients about this, and we're seeing new deals coming on, but the thing that I'm stressing more and more is preparation and thought ahead of the deal. If the right deal comes to you in the current market, you need to be able to move quickly, and you need to make sure that you've got all your proverbial ducks in a row. You need to make sure that you've thought through some of the straightforward stuff, like, have you got your contracts logged, or all the employment contracts in place? Have you gone through that process of being able to explain the unique selling points of your business and where the value is? That takes some time, and I think being clear about what you really need is also very important. That accordance deal, the VAT compliance business, those guys had spent several years thinking about what type of deal they wanted to do, and they hadn't found the deal up until that point. But when the time came, they were well rehearsed, and they knew what they wanted, and they were able to move quickly and make quick decisions. And I think that's critical. I've said trusted advisory team, which I suppose you might say, well, I would, wouldn't I? But again, in that example, and I'll give you another one, the one that closed just before lockdown. Clients need to have advisors that they know and that they can trust. You can go to market and get a series of different prices for delivering the job. The really difficult bit is whose advice will you trust when it gets really difficult and when you're making decisions about the future of your business. And this is, you know, accountants, tax advisors, corporate finance advisors, guys sort of who do the numbers around the deal, and the legal team need to be able to operate together, and they need to be able to move quickly. And that, I think, is increasingly important. Early preparation and due diligence, that's making sure you've done the mechanics and got it all in place, because that loses value. Private equity are known for this, but they will identify potential holes in your paperwork, ownership of assets, or just evidencing things which you would say running your business day to day cause absolutely no problem and don't affect value. That will affect the value of investment or the sale price that you get. So I've just wrapped up by trying to conclude some of the key things. I think diligence is key in an investment climate where there is risk and where there is uncertainty. Investors and buyers spend a lot of time on diligence. They don't want to make mistakes, and they want to spot potential problems. So that you can expect that is an area where there will be a lot of attention. We were able to get the VAT business sale done very quickly because we had prepared a long way in advance, and we'd spent a lot of time doing it. So there were really no gaps. They were able to see quickly this was a business that was well organized. Stable business sector, again, essential. That business that we sold at the end of February, supplying airlines with food, very clever, unique business, which was bought for a number of reasons, including their ability to design food and packaging creatively with a view to expanding it in the Far East. That business probably would have collapsed had it not completed that deal before lockdown, because its market has completely cratered. But again, you know, an advisory team that was well planned. They brought in an interim FD to help them sort their numbers and be very well positioned. They were able to get that deal done quickly because of that. Had they just started doing the deal, started meeting their advisors afresh, that would have been very difficult to do. So in wrapping up, I would say that there is no absolute rule for what makes a successful investable business or a saleable business. It varies from sector to sector, but I hope some of these themes are helpful in giving you a guide of what will work in the current market. So that finishes me off, Johnny, in terms of my initial slides.
Many thanks. Well, Jonathan, I'm going to be coming back to you because it won't surprise you to learn that as you've been talking, a lot of questions have come in. But before I do that, I'm going to kind of go across very quickly to Robert Gampat Singh. And Robert is one of our litigators. Eventually, I'm a litigator as well. When there's a dispute or when something's gone wrong, it ends up on his desk or my desk or one of our other litigation partners' desks. Robert specializes in intellectual property and commercial disputes. He has a wealth of experience in all forms of dispute resolution, including mediation, arbitration, adjudication, and litigation. And he's a highly experienced litigator with expertise in all aspects of resolving disputes through the courts, including dealing with worldwide freezing injunctions, search and seizure orders, and most of those in high value cases. And Robert, what I'm going to do, I hope you don't mind, is just put together a composite of the questions as they've come in, and just put them to you and invite you to come in.
Certainly.
The questioner asks, I'm a manager of a small set of criminal solicitors. The criminal courts at Crown Court level has large delays now due to the problems with jury trials for obvious reasons. How do I identify which bills to pay and which contracts to break? And the second follow-up, if you like, is I have a business interruption insurance, but to date I've been unable to claim. We know the FCA took the case and was successful at first instance last week on the 15th of September. And this questioner wants to know, what steps do I need to take now that the court hearing has taken place and how do I get the cover I need for the future? And I'm going to ask you to be fairly swift in your response, because we've got, I think, about 10 minutes left and a lot still of questions to get through. So over to you, Rob.
Good, thank you, Johnny. That's fine. So I'll be as quick as I can. So let's deal with the first one. You're a business, you've got outstanding debts across a range of different contracts, a range of creditors are chasing you. What do? Do you start picking the most risky and start paying those off? Well, it's a tightrope, isn't it? And you know, the consequences of falling off a tightrope are very, very severe. The consequences of not paying some of your contractual debts can be, you know, fatal to a business. So let's have a quick think about some of the factors you might bear in mind. I mean, look, you know, this is serious stuff. So take detailed legal advice, but I can give you some pointers. So the kind of things you need to bear in mind are: look at each of your liabilities, look at each of your contractual relationships, and say to yourself, what are the consequences of not paying this thing, this debt? If I don't pay this, is there going to be some very serious consequence on me, such as the right to terminate or forfeit my lease, for example, currently restricted by the law, but that's not going to last forever. Might there be a termination of a contract that is vital to the business? So if I'm in breach, although there are, you know, good government guidance principles in place at the moment to protect people and to force people to behave reasonably in contractual relationships, you know, that's not going to last forever either. So think to yourself, you know, what are the consequences? If I don't pay this, that's putting me in breach of contract. My contract could be terminated. Am I prepared to accept that risk? You know, it's serious stuff. On the other hand, you might have an instant impact on your credit rating as a business. If it's some kind of lending, for example. So think about those kind of consequences. And not only that, what about the actual relationship with the creditor? That must be quite important to you in some situations, in others not so important to you. So think about those kind of things. It was, what happens if I get terminated? Am I at risk of actually losing some kind of critical business asset if I don't pay this? Might my credit rating be affected? And how will my relationship be affected with the creditor? Not much more I can say about that other than speak to people. Dialogue is really, really important. Where I'm acting for clients that are chasing debts that have been affected by COVID-19, you know, we're much more sympathetic when debtors are talking to us and explaining their position. Very important. Then I'll try and be as quick as I can on business interruption insurance. So the headline news, of course, is that the FCA pursued a case trying to essentially force insurers to pay out on their business interruption insurance policies. Imagine getting a policy like that you think is going to bail you out of a situation like this, where what's supposed to happen is you suffer some terrible event like COVID-19, but not to worry, your business interruption insurance policy will say, it's fine, we're going to put you in a position as if this COVID-19 pandemic had never affected your business. That's what you hope. That's not what's happened. Some of the insurers have refused to pay out. So the FCA pushed it and have won at high court level a decision to interpret those policies that says, you need to pay out on them. That the policies do cover, causation requirements are met. So if you have one of those policies and thousands of businesses affected by this, then you need to claim any trouble claim. You need to get in touch with us sooner rather than later to push that forward, because it looks like it's going to be appeals pending, of course. It looks like it's going to be a good result for policyholders.
Well, just picking up on what Rob said there, talk to your creditors or anybody you're in dispute to in the first instance. Nothing will cause a dispute like radio silence. So to that extent, have a talk with anybody that you're having a dispute with. That's very sound advice from Rob. I've got, I think, time for 3 questions, and I'm going to put one to Victoria and one to Jonathan, and then I'm going to scoot back to Victoria again. I hope she won't hold it against me. So over to you, Victoria. I've got a questioner who's stating that she is a business owner with 5 employees, a turnover of 1.2 million, Now, the recent COVID crisis has caused a downturn in trade, and she asks what are the funding options open to her from banks and or government schemes?
Well, I guess there is a range. So a business of that size, 5 employees qualifies or defines the business as a small business, and 1.2 million as well, sort of a small business, which in the current climate could actually be very advantageous because there are a number of grant schemes available in addition to borrowing money. Funding is not just about borrowing money, but it is also about accessing different grants. So dependent upon what the money is there to support, if it's there to support immediate liquidity, then there is the bounce back loan scheme, which is has been very popular and can provide up to £50,000. If the liquidity need is above £50,000, then it would have to go through what we call the CBILS, the Coronavirus Business Interruption Loan Scheme, and that's working with your bank and talking to your bank and taking it through the relationship manager process. But the grants that I mentioned are available through a number of different bodies, and they are a key area of government support and deployment, which is increasing quite dramatically. So dependent upon your location, speak to your or explore with your local enterprise partnership available grant funding, speak to the Innovate body, speak to other partners as well across your bank manager through to your accountant who might be able to provide. But if I was giving any advice for a small business owner at this stage, talk to your bank manager. If you can't access your bank manager, get in contact with your local enterprise partnership. They have business growth hubs, boosting of awareness for the variety of government schemes available.
Again, I have to unmute myself. Very quickly, Jonathan, I'm going to ask you just to comment very briefly on this particular question. Got an individual who doesn't give their name, runs their own business in the car repair and maintenance sector and looking to join up with another similar owner-manager who is getting on in life, clearly looking for retirement. What are the things that this individual needs to look for in terms of the information to see if it's a good proposition to hook up with or not?
Okay, well, I'd start with accounts and management accounts so that you can see what the business has done over the past 2 or 3 years. As I said, most investors will look for a pattern of performance. That gives you a level of long-term visibility in terms of how the business performs. But then you need to look in some detail at what's happened over the last few months and think with that business and that business owner about how they're going to develop and change their business to help it recover. So, you know, what does the current climate mean for that business? They would have had a business plan at the, you know, probably in February, which will be completely different, I imagine, to the business plan now. So you need to work together to be able to see what that business is capable of delivering over the next 2 or 3 years. And that will help you together work out what the value is. When you're putting together businesses like that, you can do it as a joint venture. You can keep the 2 businesses separate, but you can invest together in a combined business, put it into a company if you want, work together so that you create combined opportunities and synergies. Or you could buy their business or take over their business, and if the revenues are down or the profits are down, you might have to structure it so that you pay out over a period of time. You know, that owner maybe, if he wants to retire and he just hasn't got the appetite for it any longer, may be willing to sell with a consideration payable over the next 5 years, say, based on what sort of profits the combined business can generate. So there are different ways of structuring it, but that would need a bit of care. But those are some guidelines.
Well, many thanks, and my thanks to the panel. That's all, I'm afraid, all the time we have. We're coming up to 12 noon, coming up to the hour. I've been your host. My name's Jonathan Compton, and I head up the litigation team in Guildford, and indeed head up the Guildford office. It's been great. You've been a great audience, great panel. And I think at that point, we'll all say cheerio and look forward to seeing you for our next webinar. Goodbye.